At one point, Wall Street investors poured massive amounts of capital into Chinese technology companies. However, with worsening geopolitical tensions and China's lackluster economic recovery following the abandonment of the zero-COVID policy, foreign capital has been steadily withdrawing from China, leading to a decline in stock prices and a shortage of funds for tech companies. According to the Financial Times, 2 years ago, the Chinese online entertainment platform Bilibili was valued at $54 billion. At that time, Wall Street investors were eagerly betting on this Chinese tech giant. Today, the market value of this Nasdaq-listed conglomerate has plummeted to approximately $6.5 billion, and the early repayment of the company's debt may deplete its remaining cash reserves, forcing Bilibili to significantly cut costs. Bilibili's predicament is indicative of a broader problem in the Chinese tech industry. Overseas investors are selling off stocks of internet giants like Tencent and Alibaba, while being hesitant to invest in once promising startups in China. Last week, the U.S. venture capital giant Sequoia Capital announced its plans to split into 3 independent companies by March 2024, operating in the United States, China, and India respectively. The Financial Times views Sequoia Capital as the latest company affected by the escalating geopolitical tensions between the U.S. and China, marking the end of one of the most successful U.S.-China investment alliances. The unstable nature of China's economic recovery has further fueled the flight of foreign capital, resulting in a shrinkage of Chinese tech stocks. The downward trend in stock prices has raised concerns among employees and investors that the low valuations of Chinese tech conglomerates listed in New York and Hong Kong may persist for a prolonged period. According to S&P Capital IQ data, there are currently 252 Chinese conglomerate companies trading in the US or Hong Kong that meet the definition of net, which means their liquid assets minus total liabilities exceed their market value. This group includes deeply struggling stocks such as Douyu, supported by Tencent, which has a net cash of $880 million but a market value of only $32.3 million. A stock analyst based in Hong Kong told the Financial Times, "China's losing investor support, and the economy is like a raging fire." He pointed out that J.P. Morgan Chase controversially labeled Chinese internet company stocks as uninvestable last year, a move that now seems more prescient. According to S&P Capital IQ data, the top 10 Chinese tech conglomerates have collectively lost $300 billion in market value since the start of the COVID-19 pandemic, while large U.S. tech companies have gained nearly $5 trillion. For many investors, the ongoing escalation of U.S.-China tensions serves as a constant reminder of the fate of those who supported Russian companies, whose fortunes evaporated after Russian President Vladimir Putin ordered a full-scale invasion of Ukraine, leading to severe Western sanctions. Meanwhile, the Biden administration is considering restrictions on U.S. investments in China to prevent the CCP from gaining access to advanced technologies that could enhance its military capabilities. Against the backdrop of geopolitical tensions and China's sluggish economic recovery, major foreign investors, including Western pension funds, are exiting the market. These funds have historically been major supporters of Chinese technology companies in both private and public markets. Not only are U.S.-China relations tense, but relations between Canada and China are also deteriorating. According to the Canadian press in May this year, the Ontario Teachers' Pension Plan and a company managing the retirement funds of public sector employees in British Columbia both informed a Canadian parliamentary committee studying Canada-China relations that they have suspended new direct investments in China due to increasing risks associated with China. The Ontario Teachers' Pension Plan is Canada's third-largest pension fund and invested nearly $1 billion in stocks of Alibaba and Tencent 2 years ago. Today, neither of these companies ranks among its top investments, and the group has recently laid off its Hong Kong team that was leading such transactions. APG, one of the world's largest asset management companies, stated that its pension fund clients are currently avoiding investments in China. Amid the escalating geopolitical risks, they are continuously withdrawing funds from China. Over the past year, Warren Buffett quietly sold over half of his stake in the Chinese electric vehicle group BYD. This year, Buffett purchased and quickly sold a significant amount of shares in TSMC, Taiwan Semiconductor Manufacturing Company, after reassessing the location at the center of U.S.-China geopolitical flashpoints. Winnie Wu, a China equity strategist at Bank of America, told the Financial Times that the future seems uncertain, especially for Chinese internet conglomerates. She stated, "Stocks and sectors that were once heavily held by foreign investors are facing higher cost of capital and more devaluation. Global long investors have been out for a long time, said a trader at a Chinese brokerage firm when discussing Chinese internet company stocks. According to the Financial Times, as the economy continues to stagnate, technology conglomerates are prioritizing stock buybacks and streamlining operations. Companies like Bilibili face the greatest challenge in terms of low valuations. Employees report that management has cut bonuses, implemented layoffs, and streamlined business lines to achieve a balanced budget. According to the report, the trend of foreign investors' withdrawal has hurt conglomerates like Tencent and Alibaba, which have tightened their belts and used their savings for stock buybacks. Employees of these companies expressed that the relentless cost-cutting and wage reductions have severely impacted morale. Alibaba has spent approximately half of its free cash flow over the past year on stock buybacks and has cut 24,000 positions. Employees widely anticipate that the continued split of the conglomerate into 6 entities will lead to further layoffs. Employees state that they are facing a double blow of declining stock-based compensation value and increased workloads, with stock-based compensation accounting for half of some individuals' salaries. A developer at Tencent stated, "Everyone is doing the work of 3 people." He further mentioned, "Cash is tight now, so they want to reduce costs and improve efficiency. The golden age of internet companies is over." Tencent's stock price has fallen by 19% from its peak in January, while Alibaba's stock price has declined by 29%.